Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It is the 28th of March, 2024. That is a Thursday, not a Friday. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, the charts that we reference are posted to our Twitter account at RenMac LLC. If you like what you're hearing, please give us a thumbs up on the review so we get those out there. I think we have 5 stars, guys, actually. So well done. Whoever's listening is appreciating it. We're going to hit on Biden, Trump today, the DJT, the new symbol for the Donald J. Trump stock. We're going to talk about Waller's comments, GDP, wages, what's going on with aluminum, a little bit about momentum and the consensus Inc. data. But let's go to Waller's comments, Neil. I know he kind of threw some cold water on the doves and the concerns around that. But your take is, I think, a good perspective, which is he didn't say anything new really at the Economic Club. Is that right?
Well, he did say something new for him. The question is, did he make those comments at the March FOMC meeting itself? My suspicion is that he did. There was nothing since the March meeting that should really change anybody's views one way or the other. But basically what he said is that he's been spooked by the recent data. The data we've received so far this year has made me uncertain about the speed of continued progress. These are his words. As a result, it is prudent to hold this rate at its current restrictive stance, perhaps for longer than previously thought, to help keep inflation on a sustainable trajectory toward 2%. So you can compare and contrast what he's saying. Basically, what he's saying is that January and February were not good on the inflation side, but he also mentioned the hot jobs numbers. But what's interesting is you kind of go through his speech and then you see what Powell said at the press conference, and they don't line up, right? So my suspicion is he made his case at the meeting itself. Powell heard it, and then he went about his business and said what he had to say at the press conference. So if you think about Powell, he described recent data like this. The February number was higher than expectations, but we have it at currently well below 30 basis points on core PCE, which is not terribly high. So it's not like the January number, but I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. So, and you can kind of go down the list. Same thing with employment. I mean, Waller's talking about the acceleration in employment this year. Meanwhile, Powell's made the point that stronger jobs growth doesn't necessarily mean higher inflation. I think relative to Waller, Powell's more of a supply side and productivity bull. But I thought the contrast was interesting. But I think it's, Powell, I like Waller. I think he's an important voice. I like Powell more. And Powell told us what he told us in March. And remember, the market reaction to his press conference leaned on the dovish side.
Yeah. And so the wages, which I think you put something on Twitter with this, but the wages would support the lack of wage increase, right? Would support the inflation trajectory as you see it.
Well, I think you have to ask yourself where the inflation is coming from if the labor market is more normalized. I think that's an important thing to talk about. And even with Waller, I mean, I thought his comments were interesting. I mean, he talked about the decline in quits rate, but he still talked about how wage growth was still elevated and compensation was still elevated. But I don't really see that. I mean, I see that compensation growth ran 3.5% in the fourth quarter. I see quits declining, which means that it'll probably be somewhat weaker in the first quarter. And if productivity is, I mean, look, Waller's not a productivity bull, but even if you assume that if you just take the full period of the pandemic, right, productivity growth during that time is around 1.5%. So that includes the really weak productivity growth initially, and the stronger productivity growth that we had in the last year or so. 3.5% compensation, 1.5% productivity, that basically gets you 2% inflation. So, in their sort of working model of how the world works, if you don't have much of an inflationary impulse in the labor market, where is the inflation coming from? So I think that's That's important. I mean, again, I mean, just to put a pin in this, Waller's reaction is way, I mean, his data dependence, his view of data dependence is way more reactionary, I think, than Powell, which is why it's sort of okay. We had a couple bad months, and so now it's like, okay, I got to, react to that. I mean, he even made a point about this. He's like, you don't want to overreact to 2 months, but you don't want to not react to 2 months. I mean, he sort of made that point in his speech. And I don't think Powell is as reactionary. And I think that's important to note.
Yeah.
It's so data was bad. Data can change, and if you get a 0.1 on core PCE at some point in the next few months, you can't rule that out. Frankly, Waller might be singing a different tune by the June.
The signal to noise ratio, always a tricky part of this business. How about the GDP numbers today? Was there anything in there that either one supported the improvement in productivity, which is probably too soon for that to be showing up, or any surprises that you saw?
Well, I think for me the most interesting story in the GDP data is that we got the cut of gross domestic income. Now, remember, in economics we have different ways of measuring the same concept. So, gross domestic product, that kind of measures all the spending in the economy. Gross domestic income, that measures incomes, profits, all the income in the economy. They should over time look the same. A popular bearish talking point last year was how gross domestic product was up and how gross domestic income was not. And, the idea was that, this is why we should be worried about recession. And, there is some research out there, I think, that shows that gross domestic income might be a more useful measure. There are others that suggest the opposite, so it goes to this idea that you can get economists to come to any conclusion, any opinion. But, at any rate, gross domestic income rose almost 5% at an annual rate in the fourth quarter. So that goes some way in reconciling GDI and GDP. And you'd expect that to continue because profits probably rose in the first quarter as well. I mean, if you have nominal income growing about 5%, and we know that there hasn't been much of an increase in total hours worked, it's probably going to be another month of okay productivity growth and low unit labor costs. So, yeah, I mean, I think profits are still growing, which means that reconciliation should continue between the two series.
Well, it's amazing that, given the strength of GDP, the strength of the economy, and the jobs market, that the polls are still as weak as they are for the sitting president, Biden. Must mean he's not resonating with the populace. But I think that's starting to improve a little bit from the latest polls. Steve, you want to talk a little bit about that closing gap? Is it taking place in the important states that he needs, i.e., Michigan, the upper Rust Belt, if you will? And what the fundraising differential is looking like and how that's been changing.
Well, sure. If New York listeners are, I guess, listening to this prior to tonight, try to avoid Radio City Music Hall. There's going to be a big fundraiser there with Biden, Clinton, and Obama. Probably a lot of traffic. And in terms of the fundraising advantage right now, it looks like Biden has about 3 times as much money. I think I saw something in Bloomberg, $150 million cash on hand compared to Trump with about $50 million. We'll come back to the money in a second. Because the Bloomberg battleground state poll did show some improvement for Biden, and that sort of comes after they do this every month, 5 months of consistent Trump leads, pretty much in all 7 battleground states. Now, I might take issue with the number 7. I mean, Biden didn't win North Carolina in 2020, a very favorable environment. We had a pandemic going on. I think people try to forget that. So I don't see how he's going to necessarily win it this time around. Also, if you look at Georgia and Arizona, Trump's lead not only consistent, it's outside the margin of error. And that's why I think that from the Trump campaign, they feel more confident. Again, because Georgia, you don't have a black candidate running for statewide office in the gubernatorial senatorial race this time. And in Arizona, being a border state, obviously immigration is not an issue where Biden polls terribly well. But that still leaves Trump short one, which is why, to your point, we're looking at these 3 blue wall states of Michigan, Pennsylvania, and Wisconsin. And now, according to the latest Bloomberg poll, Biden's tied with Trump in Michigan and Pennsylvania in a head-to-head matchup and is actually ahead by 1 in Wisconsin. However, in that same poll, when you introduce the third-party candidates, particularly a 5-way race that includes RFK Jr., you have the other candidates, Cornel West and Jill Stein. Trump has I believe, a commanding lead in Pennsylvania and actually has a lead in Wisconsin, which is why Democrats are really concerned going back to this third-party threat. So that's something to watch moving forward. I think in terms of when this poll was conducted, it was right after Biden's State of the Union address. I don't know how many people watched it, but I think the news coverage, at least from sort of the left leaning media, was very positive. And that may have been some influence there in the polls. That's why we're going to see whether we're going to have some reversion back to where they were, whether this is sustainable. I think 538 said usually a president gets about a 2% change in the polls after the State of the Union. So again, I think for Biden Democrats in some of these states, that bump was a little higher than that, which may be encouraging. But again, it really is going to come down to, which candidates are on the ballot. And up to you whether to talk about this later. But, I think the other news this week was in terms of Trump being able to maybe close that cash disadvantage. If you look at the trading right now of DJT in the social media, I believe, he just became a tech startup billionaire.
Yeah. Well, there's hypothecation rules against it, and we'll see, and usually lockup periods. So we'll see how liquid that ends up being. The other thing too that I just think 6 months to, us on this podcast, not a big deal. We, kind of that's just part of the way life is. 6 months to an 80-year-old is, a significant portion of your time remaining. Like easily could have issues between now and closer to the election. So that'll be certainly worth watching. In terms of the overall market, just talking about that a little bit. So, the Consensus Inc. data, I'm sorry, the Investors Intelligence data, it's a different poll, showing roughly 15% bears. That's a pretty low number. One that just says that the narrative, whatever the sort of big picture thinking, and we would place that into AI and AI advancements, is kind of dominating the landscape. And if you think about news as being historically, normally distributed, you can have good news and bad news, and people are really skewing themselves more towards the prospects of good news happening going forward. So I want to be a little cautious around that. But I think what's interesting from our perspective is if we see this momentum trade start to unwind a bit, and there was some evidence of that yesterday. We had 90% advancers in the market, and yet high momentum names were underperforming low momentum names in a pretty significant way. In fact, you could see it monotonically through what was going on in terms of the performance of small versus large caps. So the smaller the index, the better the performance, all the way on up to the mega cap S&P 100, which underperformed everything else. So pretty obvious what was going on there. But this broadening out, if you will, is making for some strange bedfellows. We're seeing some improvement in aluminum names, as an example. We're seeing improvement in specialty chemical names, some of the materials acting well. The iron ore producers not acting well, the BHPs and the Rios of the world at the completely different charts than, say, the Freeport-McMorans and the Southern Coppers of the world. So certainly from an economic perspective and kind of thinking about it globally, these are usually pretty good indications that things are firm and probably firming. So we like what we're seeing there. All right, Neil, what do you have next week?
So remember, I just want to remind everyone, core PCE comes out tomorrow, even though the markets are closed. Markets are looking for 0.3% on core PCE. Wouldn't be surprised to see 0.2 on the core services ex housing number that the Fed's paying attention to. And then next week, April Fool's Day, we get ISM manufacturing PMI. Markets are looking for a modest increase. Remember, the S&P global manufacturing PMI is already above 50, and folks are looking for the ISM to go up to 48.5. And then we end the week with the jobs number for March, and that's expected to come in around 215,000. Remember, in February we had 275,000. I do think revisions are worth watching with respect to the payroll number, because those revisions have been very fluky of late. I mean, they've been sharply negative. It hasn't changed the overall story, but we have seen big revisions on the payroll number. And the household measure of household survey, people are looking for unemployment at 3.8%. There's nothing in the jobless claims data to suggest a big increase in unemployment is coming. So I do think that's notable. We're sort of, I think, flattening out. So that's what we should expect. And that's it from me.
Steve, how about Washington? What's going on?
Washington should be pretty slow. We got Congress still out for the second week of the recess period. I don't know if it's going to happen next week 'cause we don't have confirmed dates, but was reported that Treasury Secretary Janet Yellen is going to be making another trip over to China. She's probably one, if not the most dovish administration officials with respect to China. And I'd be surprised if the subject of tariffs on EVs don't come up, given what Donald Trump said about his idea of putting 100% tariff on Chinese EVs made in Mexico. And we've already had reports that Biden administration was actually considering raising tariffs on that in terms of their own goals of boosting domestic production. So that's sort of what I'm waiting to see more in terms of what that meeting may entail.
Well, in terms of the overall markets, the S&P is still in an uptrend. The ascending 50-day moving average at 50.36, so should hold most of the tactical weakness that develops. 10-year yield 440 is resistance with 403 support on the downside. And then Bitcoin 50-day moving average also ascending 6880 is the support level there. Well, happy Easter, guys. Happy Good Friday. You ever wonder why they call it Good Friday? I mean, Jesus can't be happy about that, right? I mean, man, I wouldn't be. But join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter for updates. And if you want deeper insight, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.